consumer inflation rose by a lower than expected 4.2% last month from 4.6% in May. The market had been looking for a reading of about 4.5%. On a monthly basis, inflation was flat after a 0.2% rise in May. Joining me with more is Mike Schussler from economists.co.za. Mike, thanks for coming in this afternoon. I know the market was looking for a figure of around 4.4 or 4.5%. What were you expecting?
I was thinking 4.6, sort of. I think it was going to be bottoming out. I'm very surprised at this number, I must say, and I haven't had to look at all the detail, but it does seem food prices remain low. And certainly from the World Cup side, there's a nice little note in that thing. It says, yes, hotel rooms went up 28%, I think it was, year on year. But aircraft seats actually declined with 3.5% year on year, which is something that one wouldn't have expected during the World Cup. And not that it makes up a big part, but the fact of the matter is we didn't get a bit of a World Cup bounce in this whole process, which shows that probably at the moment inflation is very much under control and we should be all quite happy about it.
In fact, just with those aircraft seats, because I know that just before the World Cup, Match put lots of those seats back on the market because it didn't look like we were going to get all the people that were going to come to, all the fans that were going to travel to South Africa. So that perhaps backfired a little bit on the airlines.
Yes, it absolutely did, I think. Match didn't quite match their expectations of South Africans, and that's one of the things that we did have. I am a little bit concerned that we're getting to this point where inflation is really, really low, but is it sustainable? And I don't think in the South African sense it perhaps is. But then maybe, about many things, us economists on the more negative side have been wrong for quite a while. For example, the strength of the rand continuing to be very strong. That keeps food prices and petrol prices and so on a lot lower. And we sort of have to come to that into our mind and start working out on a much lower inflation base. But the other thing is that it's quite surprising that there's no throughput from all these electricity prices that have been hiked.
Yeah, because June should have been the first month for that, shouldn't it?
July for the households, but April for the industry. And one would start thinking to start seeing some of those price increases being passed on to consumers, because in some areas, for example, in the transport arena on the trains, electricity makes up to 20% of your costs. So one would expect to see, some transport components starting to increase there. And I think we will still see that. It might just be a little bit of a delayed reaction. But having said all that, I think very good numbers probably indicates to us that for the rest of the year we might have a lot lower inflation as such. But I don't think it changes my base outlook on, say, a year's time that we go much closer to the 6% mark again. And that, I think, is where the interest rates are going to play a bigger role, because interest rates are forward-looking, not backward-looking.
Because we had Reserve Bank Governor Jill Marcus saying at the winding up of the MPC last week that they expected to maintain or stay within the inflation targets until the end of 2012. Do you think we could break out of that target before the end of 2012?
I would have to redo my models, but at one stage I would say, before these numbers came out, I was thinking we're probably going to break out of these targets by the end of next year. There are many ifs and buts with all this, but a central forecast would be that you don't have too much of a weakening of the rand, I guess, from the central bank. I think that's always a little bit dangerous, because we have seen that our currency is very volatile in whichever direction you throw it. And the one thing that would happen, for example, is you could have a 15% weakening of the currency virtually overnight, and that would add within a few months at least 1.5% to your CPI quite quickly, and that it would be somewhat of a problem, obviously, if you have that. But given that the currency remains stable, yeah, it's probably very realistic to now expect us to stay within inflation targets, or at least, even if we break out, quite close. Not a 6.5 breakout, but a 6.1 or 6.2 breakout.
How about these huge wage settlements we've been seeing over the past few months? When did they start to filter into the system? You
see, that's what I'm worried about, that something's not making sense to me. We had very high wage settlements last year. If we look at it overall, we had the average person that remained in a job got a 15% increase last year. That's what people don't realize. Although companies only paid 12% more, the other 3% was made up by job losses. So essentially wages are a part of this problem, plus electricity, plus water, plus a lot of administrative prices that are still there, and yet we keep getting this low inflation. It says to me something else is happening in this economy that we haven't quite looked at. Certainly the rand is helping to keep inflation lower. I think everybody understands that part. But there has to be some sort of inflation pressure coming through, especially from things like wages and administrative prices.
Well, you mentioned job losses, and of course we had numbers out yesterday that showed that 61,000 jobs were lost in the second quarter, and of course 232,000 year to date on top of the 870,000 jobs lost last year. Unemployment at 25.3%. How do you weigh that up with the benign inflation picture at this point and work out whether interest rates should have been cut at last week's meeting or potentially in September?
The first thing is, do interest rates really make a difference with jobs? And that evidence is not clear. And it seems in South Africa's case, yes, lower interest rates do help in the shorter term with jobs, but it doesn't seem to help in the longer term. So there's something else wrong in the job market. It's definitely fundamental. And it might have to do with job prices, with other words, the price of labor, and it may have to do with the rules of labor, and certainly the affirmative action would be part of those rules. And it's a very hush-hush thing because nobody wants to talk about it. Everybody thinks if we're going to have a weaker rand, which hasn't proved to help jobs at all, the data doesn't support that, or lower interest rates, maybe a little, but not much, would help jobs. But the fundamental thing of jobs is that we've got a fundamental problem. And part of that is also education. We have a stuffed up education system, put it very mildly. I could use very bad words. But here's the
Family channel.
Yeah, family channel. But here's the crux of it. 4 out of 10 adults in South Africa work. Other than Gaza and Iraq, there are hardly any countries in the world where that is so. Even African countries, we're the last of the African countries as to the amount of people, percentage-wise, of adults that are employed. Then if we look at that, we have a lot of youth and we have a lot of old, or a few old people as well. Only 1 out of every 4 South Africans actually works. But those that actually receive a salary actually becomes sort of 1 out of every 5. And quite frankly, those in the formal sector becomes 1 out of every 6.5. So the formal sector is really carrying the burden of everybody, the people that are working. And that's the crux of the matter. And we have to address that with something totally different to interest rates. I know people in the markets always think interest rates, rand, and that's where the markets are, and those are many of your viewers. But with regards to labor, it's a different type of solution that we need. And it includes things from education to the rules as to how things work.